Alright, so for chapter 10, I don't know we can cover how many, okay, but we just do our best, okay. Chapter 10, we're gonna cover liability. Alright, so I give you one example, okay. If this company, ABC company, borrow $100,000 from you, mean anybody, even you are the shareholder, even you are one of the shareholder. This company borrow $100,000 cash from you, and each party agree the market rate right now is 10%. Of course, right now it's not, but assuming right now the market rate is 10%, and your company agree upon 10% rate. Alright? So market rate is 10%, and your company agree to 10% to this lender. Alright? So on the certain day, your company receive 100,000 cash and issue a note payable, 3 years, 5 years, doesn't matter. And this note is not due. The balance is not due for 3 years, for 5 years. That means your company by the end of each year, only pay the interest. So let's do this. Let's make out a very simple example. On January 1st, 2011, okay? On January 1st, 2011, your company received 100,000 cash from Mr. James. James could be any person, okay? And your company received 100,000 cash, and you are the accounting for ABC company. How did you enter this transaction into your T account? Alright? This is our first example for today. Any answer? When your company receive 100,000? Yeah, always pick up cash first, right? When your company receive or pay cash, always pick out this account. Cash, right? So let's say cash account, and we know cash is assets, right? No any issue, right? So 100,000 on which side? 100,000 on which side? Left side or what side? Right? We still have two answers, okay? Left side or right side? First, this is this. Left side, okay? Left side. Okay, if you really still got confused, go back to here. Always, okay? If you cannot answer, in your mind, then look at this chart. When you're looking at the chart, it's a lot easier. Right? If you still cannot determine what level is right, then go back to here. So that's the reason why each time I will write it down this on the board. For you it's the same thing. You just make out one page paper in your book. So every time if you still got confused, just look at this chart. Alright? And the cash is assets. When assets increase, this is an increase. Your company receive 100,000 cash, right? So it's on the debit side. You say left side, debit side is okay. And I want to give you opportunity to think about this. Should be no any problem, right? Your company receive 100,000 cash here. It's okay, right? However, you need to pick out another account to match this 100,000, and we know for this account you will enter this 100,000 on the right side to match this transaction. So what is the account you want to pick and to match this transaction? Liability, but give me the name of the account. The good thing is you pick a right category already, right? We know you pick out the liability, but can you give me the name of this account? What kind of payable? No, we don't use account payable, remember. I say don't get confused. Account payable usually means like 30 days payment. And this is 3 years, I give you this is 3 years. No, the payable. So don't pick out account payable. Account payable usually means you purchase the inventory and you pay within like 30 days. Then, because the difference is account payable is called current liability. It's called current liability. You need to pay something very short time. And note payable, according to your agreement, you don't need to pay 100,000 right away, right? So we pick out another one. It's called note payable. And Dr. Liu already mentioned, right? We pick out the right category, liability, so we know increase. So give you another opportunity to think about this. It's fine, right? For this transaction, it's totally okay, right? So assuming this is January 1st, 2011, and remember our agreement is 10% per year, and you got a very good deal because you don't need to pay anything. You don't need to pay anything. We just simplify the whole situation. You don't pay anything. You don't pay the principal for 3 years. Not even better than that, you pay the interest. Not every month, you pay the interest by the end of the year. So right now, we have the fast forward. Okay, well, fast forward. Right now, we go to December 31st, 2011. And today, your company paid 10% of 100,000. This is 10,000 cash as interest. So on December 31st, your company paid 10,000 cash interest. And how are you gonna do? How are you gonna do for this?
Reduce cash?
Right, because you pay off cash, so you pick up the cash first. Right now, cash reduce, you want to, and the amount is 10,000. You want to use put into which side? Credit side or right side, right?
That's right.
Well, how about the other account? You know, you have to pick another account, and we know you need to pick another account, and that is 10,000, but on the left side. So what is the other account you want to pick? Slowly, okay, don't give me too fast, okay? Slowly think about that. You pay off this 10,000 as what?
Interest.
Interest is what? Be careful. I know interest, but interest is what?
Expense.
Expense. So that's why I say the third point I just mentioned, I say, hopefully you can take away from this class. I know this is difficult. Unless you do a lot of homework, otherwise you still cannot overcome it. Interest here is not payable. I don't mean interest cannot be interest payable, okay? There is another item, it's called interest payable, which is under the liability. But I'm not talking about it right now. Because today, December 31st, you pay 10,000 cash to cover interest. But right now here, this interest is called interest expense. So I say it is difficult. It is difficult. Even though you pick out the interest right name, but you put on the wrong category. Put on here. So here, it's easy to identify because if you pick out here, you cannot match. Because if liability increase is on this side, and cash is also on the right side, you know you got trouble. So even you pick out the wrong category, you know you got wrong, right? So interest expense is correct because when interest expense increase, you know there's 10,000 on the left, then match cash on the right, 10,000, expenses, same amount on the left. So you know you can cross reference. So we have interest expense. All right? Any questions so far? Any questions so far? So this payable is for 3 years. For 3 years. So every year you just put down here. Every year, just you pay 3 years. All right. Any questions so far? This just repeat 3 times for interest expenses. So far so good, right? And then when you pay this last interest on the same day is also the day due for the balance. You also need to pay $100,000 cash to pay off the total balance, right? So here you pay off here on the same day. You pay $10,000 to cover interest expenses. You also pay out $100,000 cash. However, when you have this $100,000 here to cover the balance, what is the account you need to pick and to match this $100,000 on the left? What is the account you want to match? Remember what I say, right? This is your loan balance. Everybody? Everybody? Because if you come here just sitting here and to just take the note, you will not learn anything. You need to practice just like yourself sitting in your room when you study. So if you can answer these questions, you just write it down this number, that means nothing. They mean nothing. When you go home, you still don't know anything. So I want everybody in this classroom in the same pace, same progress. Everybody. I have a few answers already. No, payable. Go back to here. So, this is the whole transaction. I just give this examples of 3 years. Could be 2 years, could be 4 years, could be 5 years. And in the real life, eventually it's more complicated. Because in the real life, usually the company may ask you to pay monthly payment. Monthly could be interest only. Could be interest and the principal. And the whole thing more complicated. However, the fundamental concept is the same. So at least, from here you at least grasp, you learn something for the very basic. And even though you don't want to become the accounting professional, but as a manager or business owner, you know how to read, or probably you know how to prepare your tier account. So
is it what? Equity?
say it again.
Equity.
What kind of equity?
It's not.
No, note payable. Note is mean nothing, but payable. This word payable, we know payable is under the liability. Right? And for chapter 10, we talk about liability. So for chapter 10, nothing related to equity. So again, okay, from this class, when we finish this class, never confuse cash to any other category. Cash only under the assets. You cannot put cash to equity. Cash does not belong to equity. And the note does not belong to equity. It's a very, very clear cut. So at this moment, hope this issue settled, right? Hopefully. This issue settled, right? Give you a little bit more time to think about that.